Gold just closed back above $4,700 an ounce. And with only a few trading days left in August, this is on pace to be its best month since 1999. 27 years. Most people watching this video were not investing money the last time gold had a month like this one. The story everyone's telling you about why is simple. The Treasury said it would start buying back its own long-dated bonds to hold interest rates down, and gold took off. That part is true. It's just not the whole story. Because one of the most respected macro investors alive just went into the Wall Street Journal and picked that exact intervention apart in public. A man who worked alongside the current Treasury Secretary for years, arguing not that the move is risky, but that it's already failing. And there's a genuinely uncomfortable piece of history that backs him up. Because the last 2 times American authorities tried this exact playbook, the opposite of what they wanted happened. Quick question before we go further. If gold just had its best month in nearly 3 decades, and you didn't add anything to your position during it, be honest with yourself for a second. Was that about price, or was it about doubt? Subscribe if this kind of breakdown is useful, and tell me which one it was for you in the comments. I think the answer says more than people give it credit for. Here's exactly what happened. In order, on Wednesday, August 19th, the Treasury announced it would at least double its long-end buyback ceiling from $2 billion to $4 billion per operation, starting September 9th, targeting bonds in the 10 to 30-year range. The trigger was a 30-year Treasury yield that had just touched roughly 5.3%, close to a 2-decade high, with the national debt having crossed $40 trillion days earlier. Treasury framed it as liquidity support. The market read it as an attempt to cap a price it didn't like, and gold ran hard up more than 13% for the month, trading above $4,700 for the first time in over 3 months, on pace for its best August, and really its best single month of any kind since 1999. Before we move into today's topic, let me take just a moment to point you towards something I genuinely believe can make a difference if you're serious about understanding precious metals. It's called the precious metals trap. And this isn't simply another book about whether gold or silver is going up or down. It's about understanding what happens behind the price, the psychology, the common mistakes, the risks, the hidden markups, and the traps that can quietly cost investors far more than they realize. Because knowing the price of gold or silver is one thing. Knowing what you're actually buying and what could go wrong is something completely different. And because so many of you have been asking about the book, it's currently available at 50% off for the next 3 days. So if you're serious about becoming a more informed precious metals investor and you want to understand the market beyond the headlines, I'd strongly recommend taking a look. You'll find the link in the description and the pinned comment. And with that said, let's get back to today's topic. Now, here's the detail almost nobody emphasized when they covered this. Yields did fall right after the announcement briefly. Within a day, they'd largely round-tripped back toward where they started. So whatever the intervention was actually designed to achieve on the interest rate side, its effect on the number it was aimed at had mostly evaporated within 24 to 48 hours. Gold, meanwhile, kept climbing anyway. That's worth sitting with, because it's the first real piece of evidence that this wasn't simply gold mechanically tracking a falling dollar or falling yields. Something else was going on. That something else showed up Monday when Stanley Druckenmiller, founder of Duquesne Family Office and a man who mentored Treasury Secretary Scott Bessent decades ago at Soros Fund Management, published an opinion piece in the Wall Street Journal taking the buyback plan apart line by line. His central argument was that this was never really about liquidity. Treasury had justified the larger operations by pointing to what it called strong sponsorship from market participants in the affected sectors. Druckenmiller's response, in substance, was that strong sponsorship is what a healthy functioning market looks like. Plenty of active buyers and sellers is the opposite of a malfunction, not a symptom of one. He ran through what an actual bond market emergency looks like. Failed auctions, dealer balance sheets seizing up, forced unwinds. The kind of thing that happened to U.S. Treasuries in March 2020, or UK, gilts, in September 2022. None of that had occurred here. Trading was orderly. His conclusion, in his own words, was blunt. Governments defending prices against fundamentals always lose. His broader point was that the long-term Treasury yield functions as the last real fiscal discipline the U.S. has left, the thing that eventually forces an uncomfortable conversation about spending and deficits, and that artificially holding it down doesn't fix the underlying problem. It just postpones the day that conversation becomes unavoidable at a cost that compounds the longer it's delayed. Here's the rehook, because this is where the story stops being just one op-ed and starts being genuinely historical. This exact playbook, a government authority buying long-dated bonds specifically to push long-term yields down, has been tried before, twice. And both times, long-term yields went up afterward, not down. The Federal Reserve's first round of quantitative easing expanded in March 2009 to include direct Treasury purchases alongside a much larger pool of mortgage-backed debt, aimed squarely at pulling long-term rates lower. The 10-year yield rose over the following months. Then in November 2010, the Fed announced a second round, roughly $600 billion, at about $75 billion a month through mid-2011. The 10-year yield rose again. Twice, an institution that can genuinely create money without limit, buying in the hundreds of billions, tried to push a price down, and the price went the other way. Because markets weren't just pricing the purchases. They were pricing what the purchases implied. More money being created tends to mean more inflation down the road, and investors demanded more compensation to hold a 30-year claim on a currency being created faster. What's happening right now is a far smaller version of that same idea, a few $billion a month, from an institution that can't print and has to fund its own purchases by issuing other debt. If the much larger version of this didn't achieve its stated goal, there's a real question about whether the smaller version was ever likely to either. Which brings us to Friday, and why it matters more than it looked like it would a week ago. New Fed Chair Kevin Warsh delivers his first Jackson Hole keynote this Friday, August 28th, an event that hasn't happened yet as of recording this. Warsh has been on the record for well over a year, going back to before he even took the job, arguing for a smaller Federal Reserve balance sheet and less central bank footprint in markets generally. And he's repeated that view multiple times since being sworn in this past May. To be precise about what that actually means, Warsh's stated target has been the Fed's own bond holdings, not Treasury's buyback program. Specifically, those are two different institutions using two different tools. But the underlying philosophy that markets, not a government buyer, should be the ones setting long-term borrowing costs sits in real tension with what Bessent's Treasury just did. And there's a personal thread running through this too. Warsh and Druckenmiller have known each other for years. Whether Warsh's remarks Friday sound sympathetic to the Treasury's approach or closer to Druckenmiller's critique is a genuinely open question. And it's one of the more interesting things to watch this week, separate from whatever he says about the actual path for interest rates. I want to give you the honest complication here, because it's real, and I don't want to smooth it over. Druckenmiller's preferred fix isn't more debasement, it's the opposite. He wants yields allowed to rise, because he sees that as the pressure valve that eventually forces spending discipline. But rising real yields have traditionally been one of gold's biggest headwinds, since gold pays you nothing while you hold it, and higher yields raise the cost of that choice. So the same argument that supports the long-run structural case for gold, a debt load that eventually has to be resolved through inflation, default, or genuine fiscal discipline, is in its immediate policy prescription. Arguably gold negative in the short run. That tension is real. And anyone telling you this story points cleanly in one direction the whole way through isn't being fully straight with you. Where things actually stand on price. Gold is trading in the mid $4,600 to above $4,700, still well below its January record above $5,590, but firmly above its 200-day moving average, which sits in the $4,500 a level analysts have pointed to as evidence the metal had genuinely bottomed after a summer low near $3,940. Silver is trading near $69, lagging gold's move this particular week. According to World Gold Council data, global gold-backed ETFs pulled in roughly $5.5 billion in August, their third straight month of net inflows, with North America and Europe leading. Central banks bought around 288 tons of gold in the second quarter alone, continuing to buy even during the price weakness earlier in the year, which matters, because that's not the behavior of money chasing a headline. It's the behavior of institutions that had already done the math before the headline existed. So, what would actually change this read? If Treasury keeps expanding these operations without renewed market pushback, and yields genuinely stay lower for a sustained period, then the "this is already failing" argument doesn't hold up. And it's worth saying so plainly if that happens. If Warsh comes out of Friday's speech sounding aligned with what Treasury just did, rather than with the balance sheet shrinking philosophy he's held for years, then the tension I've described here isn't really a tension at all. Those are the two things actually worth watching, not the headline gold price on any single day. One more thing worth knowing, since it's part of the same story and broke just today, hours after that Druckenmiller op-ed ran, it started drawing attention for a different reason. An AI detection tool flagged the piece. And Druckenmiller reportedly didn't deny using AI in drafting it, telling one outlet essentially that he wasn't embarrassed by it. That doesn't change who wrote the argument or what it says. It's just a strange, very current footnote to a story about an intervention that's supposed to be shoring up confidence in how the government manages its own finances. So, here's the shape of it. Gold just had its best month since 1999. The intervention that supposedly triggered it had already lost most of its measurable effect on the actual number it targeted within about a day. One of the most respected macro investors alive publicly called it price management rather than liquidity management, using words about as blunt as that world gets. History shows the much larger version of this exact move produced the opposite of its stated goal twice before. And the man now running the Federal Reserve may hold a philosophy that sits closer to the critics than to the Treasury. None of that guarantees where gold goes from here. Genuinely, nobody knows that with confidence, and treat anyone who claims otherwise accordingly. But it's a considerably more interesting explanation for the best month in 27 years than the buyback worked. If you want me to follow up the moment Warsh actually speaks Friday, let me know in the comments and subscribe so you catch it. This isn't financial advice. Do your own research before acting on any of it. But now you know what's actually sitting underneath the headline number.